It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's the Jill on Money Show. This is the program that takes the mystery out of your financial life. I am Jill Schlesinger, CBS News business analyst. I'm also a certified financial planner. And my executive producer, Mark Talercio, is also a certified financial planner. And we try to help you take the next best financial step on your journey. And the journey is your life. The money is just a means to get you there. If you need some help, just give us a holler. Go to jillonmoney.com and click the Contact Us button. That is what Mark from Wisconsin has done. Hello, Mark. Welcome to the show. What can we do for you, sir?
Hi, Jill and Mark. Thanks for the opportunity to talk to you. Why I was reaching out was just to see what am I missing or where I can improve as I look towards my future.
All right. Well, how old are you, Mark?
I'm 37.
37-year-old guy. Are you partnered? Are you single? Where are you?
Single, no dependents.
Do you own a home?
I do.
And how much is the house worth?
About $220, $225.
Okay, that's great. And what about a mortgage? Do you have a mortgage that's outstanding?
I do. I have about 14 years left. Refied it last year to a 3.25, so about $85,000 left on the mortgage.
Oh, that's not bad at all. And you work, how much do you earn?
Right at $80,000, and then I have a bonus that can get me up to an additional 25% each year.
Wow, that's pretty good. Do you find that bonus is consistent, or is it should we factor that in, or do you not really count on it?
I guess I never really count it until I have it. But yeah, it's been fairly consistent over the last few years of at least somewhere in that 15 to 20 range. That's
great. Okay. Right now, do you use a retirement plan through work?
I do. I have a Vanguard employee savings plan, 401k.
And how much do you put into the retirement plan? What percentage do you put in there?
I put 10% in total. I do 3% in the pre-tax and then 7% in the Roth. And then my employer also puts in an additional 7%.
Whoa. They match 7%? That's amazing.
Yeah, they do it based on your years of service.
Wow, great. How much money's in that plan right now?
Right about 170.
Terrific. How about some cash on hand? Any emergency reserve fund?
I do. I have about $85,000 cash on hand.
Great. Any brokerage account money?
I do. I just started one last year, so I put the $6,000 max in last year for the Roth IRA.
Oh, great. So it's a Roth IRA. Perfect. Okay. What else are we missing in your game plan right now?
I do have like a small life insurance policy that was taken out when I was a kid. I don't know a whole lot about it. I don't know if I put money towards it to keep it going last year, but I don't know if I'll keep doing that or not.
Okay. Whenever someone has life insurance or when they're asking about life insurance, the first thing I think is, do you need life insurance? It's one thing that, I know that a lot of parents and grandparents of a certain age created these policies for their kids, mostly not because their kids needed life insurance, because some salesperson said, well, you should buy your kids some life insurance. Then you're insuring their insurability, which is like one of those annoying things, which is silly to say. But right now, you don't have any need for life insurance unless someone is relying on your income. Are you supporting anyone else, maybe a sibling or maybe even helping your own parents?
Not at this time, just me.
Oh. Okay. So, chances are you don't need life insurance. Okay. So that means you have, I'm going to give you a little homework. Your homework is you're going to either call the 800 number on the policy statement or the person who sold it to you, but most likely just use the 800 number. And you're going to ask for a couple of pieces of information. You're going to say, number one, what is the surrender value of my policy? Meaning, if I cashed it in right now, what would I get? All right. Number two, what is the taxable part of that? Meaning that when you have a life insurance policy that is a permanent insurance policy, there is a tax component of it when you cash it in, which is if it has grown to a larger value than the amount of money you've put into it, whatever that difference is between what you put in and what you're cashing it out for is ordinary income. It does not mean that you shouldn't cash out of it. It just means I want to know what the potential tax hit would be if you were to get out of it. And then the only other thing that you want to ask is, so we're going to get a surrender value, what your tax liability would be. The third thing is, if I never put another dollar into this policy right now, how much insurance would be paid up? Meaning they give you a number, like right now, it may be that you have a $100,000 or $50,000 policy. They might say, well, given the amount of money that's in there, we can keep this thing in force, but it's only going to be $30,000. They'll give you a paid up amount that will give you a sense of how much insurance it is. But my guess is you're probably just going to want the money. But let's find out these 3 bits of information and you can follow up with us, okay? Now, who's the beneficiary of this small life insurance policy, by the way?
My parents are on it.
Okay. What else is on your mind in terms of when you say, what am I missing? What do you feel like you're missing?
I don't know. I guess it's more of just a peace of mind thing that I guess I'm doing all right.
You're doing great. Putting money away. This is great. It's a great thing. Mark's going to say you should put more money away. Am I right, Mark?
Put away what you feel like you can put away. But I would make those contributions all Roth.
Do you have to put 3% pre-tax to get their match or not?
No, I don't. The Roth just became available a few years ago. So I've been doing the traditional, and then I just kind of been stair-stepping it the other direction. Yeah,
I mean, I think, look, you're a single guy, which means that you're in the 22% tax bracket. All right. You have it. You have your mortgage interest. You may even, I'm not even sure, just because you don't have such a big mortgage, you might even just take the standard deduction at this point. But even so, you're in the 22% tax bracket. I would go all Roth also. Absolutely. And you've got a nice chunk of money that's in the emergency reserve. You're putting money into a Roth. So you're putting 10% plus $6,000 a year. You're doing a great job. Absolutely great job. If you find that you've got extra money and you want to do something, you may be the kind of person who has this little thing in your head saying like, oh, I want to pay down my mortgage. Don't do it. Don't do it. If you're thinking like, should I pay down my mortgage? I say absolutely not. If you've made your retirement contribution plus your Roth and you had a great bonus here, open a plain old brokerage account, a taxable brokerage account. And that will be fine for you. Absolutely perfect. Do you like what you do for a living?
I do.
All right, then keep doing it, man. Yeah. I think you're in good shape. I really feel good about it. And you're a really good poster child for, you make a good living, but you're not making a gazillion dollars and you're saving and you're living within your means. It seems to me you're in a great place to kind of just keep clicking away, enjoying yourself and having a fun time. Let's find out about the life insurance policy. When we return, more of your questions. It's Jill on Money, and we will be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. And if you would like to come on the program and ask your financial question, it's very easy. Just go to jillonmoney.com. A website that you should be bookmarking no matter what, just because you never know when a financial question might crop up. On the website, you can just click the Contact Us button, ask your question, and if you'd be willing to come on the air, Mark will do the rest. That is what Dave did. He's on the line from New Jersey. What's going on, man? What can we do for you?
Hey, I'm 53 years old, thinking about retirement. That'll probably be maybe when I'm 60, but I wanted to get some feedback from you guys on where I am and what I'm doing.
Okay. So tell us more about you. What's going on? Do you have a spouse, Dave?
Yes, I have a wife, 52 years old.
Okay. And do both of you work?
We both work.
Okay. How much do you earn together?
Together, 260.
That's nice. Good for you. Are you both contributing to retirement accounts?
So I am. I contribute my max, which is 26,000 last year.
Okay. So you're maxing out retirement. And are you putting money in a Roth or a traditional retirement?
Traditional.
Okay, got it. And your wife is not?
She is not. I'm doing that part for our family.
Okay, very good. Family, kids?
I have one son who's a senior in high school.
Oh my God. What do you think about this? Like, is his high school experience must be so weird. Is he back in, everything is good now? Or is he like mad that he got robbed of a couple of years of high school?
He's a good sport. He's happy, though, that, for the end of his senior year, the second half, they won't have masks. They won't have restrictions. It's a little more relaxed.
Yeah. Keg party at Dave's house. Oh, wait, no. I'm sorry. Okay. And is your son heading to college?
Yes.
And is that college been paid for, or are you going to pay it out of cash flow? What are the arrangements?
So we have a 529 with about 84,000 in it. And I hope to cash flow the rest.
Mm-hmm.
We'll see. Depends on which college he ends up going to.
Can I make a suggestion of Rutgers, or would that not go over well in the house?
He's not interested in Rutgers.
Of course he's not.
Yeah.
Why do these? We give our children way too much choice, says the woman with no children. What is the price tag going to be? Is it going to be one of these 50, 60 grand a year kind of places?
Yeah, we think the low would be like 40-ish and the high would probably be 61-ish.
All right. So if we say 50, that's fair. Yeah. Okay. And do you feel like you can cash flow this? Like, in other words, are you going to stop putting money into retirement, or do you feel like on your 260 right now, you can actually pay for the differential?
We do not plan on changing our retirement contributions at all. Mm-hmm. I do think we can cash flow the college program. And if I have to pull a little out of brokerage to make it work, we'll do that. But I think once he's out of the house, it'll be it will be an empty nest. Mm-hmm. So I think that'll make things work.
You mentioned a brokerage account. What do you have?
330.
And how is that invested? Mostly in mutual funds or stocks? What do you got?
It's mostly indexed mutual funds, equity with Vanguard.
Okay, that's great. That's great. So that is good that you have that. I mean, so if you had to, you could certainly pay for it. Tell me how much is in your retirement accounts.
403Bs and one traditional IRA totals 520.
And you're accumulating quite a bit in there now, I presume. And what about, are you either or both of you entitled to a pension?
Both.
Wow. Tell me more.
Yeah, we both work in New Jersey public schools. She's been doing it longer than I have, so she has a little better formula. Mm-hmm. I make a little more money, so I have a better bottom line.
At 60, so this is like when you're both 60, what's the number for the pension?
Oh, I'm so glad you asked me that. I'm ready.
Yeah.
So when I'm 60 and she's 59, my gross pension would be $7,400 a month. Yes. Hers would be $6,000 a month.
Okay.
Combined, $13,500 a month. Mm-hmm. And I'm trying to figure out what would be a reasonable net figure to figure, with as far as taxes. So I've been saying maybe 77% of that I'd take home, maybe. So that would be about $10,000, a little more.
Let me ask you a question. How do they do the healthcare in New Jersey?
So if you've been in it long enough, there's a really, really good deal, but neither one of us have. Mm-hmm. It looks like, you definitely can roll into a state healthcare program. Mm-hmm. I'm not certain of the rate. One of my friends who I just hired back, who's retired, is only paying like $200 a month. So she's pretty happy about that. If I could get a deal like that, I'd be thrilled. Mm-hmm. What I'm kind of thinking about now is that the mortgage payment I make now, when that's gone, right about the time I'll be retired, I'll kind of just consider that as that's probably going to be my equivalent healthcare.
Okay. Tell me, how much is your house worth?
About $540,000.
And what is the remaining mortgage?
$124,000.
What's the rate?
4%.
What do you think you need to live on if the mortgage is gone at that time, at age 60? What do you think is the actual amount you'd like to count on for living expenses, needs, and wants? Like, what would you like to be able to have?
Yeah, so we're living on right now about 10 to 12,000 a month,
Okay.
which is higher than I'd like. It clearly fluctuates. That includes, a mortgage, but really when the mortgage is paid for, only half the payment goes away because about half the payment is taxes and insurance. So maybe, 10, 11 would probably work.
Okay. I mean, out of 13,400 a month, even if you cleared 9, which seems like pretty reasonable assumption, 9 out of that.
Right.
That's not bad. What about Social Security? You've got a future benefit amount. Do you happen to know approximately what that would be for you guys?
Yeah, I know. Well, I know mine. So my Social Security at age 67 would be 3,200. That's what the calculator says right now from the Fed.
Yep.
And at 70, it would be like 4,100.
I mean, so obviously,
my wife's is, probably a little less, but not too far off, I bet.
I mean, it's interesting because the way I look at this is if you retire at age 60 and you start collecting your pension, here's a few things that we have to think about. One, you've got this brokerage account. Are you contributing more money into that account as time has gone by? Or is that like kind of, I don't know how you got that. But, if you're maxing your retirement account and it costs you 10 or 12 grand to live, are you actually adding to that brokerage account?
The plan's always to add to it. And sometimes I do, sometimes I don't. I haven't been lately. I feel like my living expenses have gone up from the last couple of yeyears. I'd like to still throw more money at that. But with my son going to college, I don't think that's a reality.
Yeah, I don't think so either. I don't think so either. Here's what I'm thinking. I kind of am looking at 3 different phases for you. I'm looking at the phase of college. Okay, so what do we do to get prepared for college? I think it's a lot to ask to actually fund college out of cash flow because it's a big number. This is a lot of money and I think it's almost too much pressure. It's not worth it in many respects. So we're going to know whether it's 40, 50 or 60 grand, right? So let's say it's 40. And if that's the case, then what I think you should do, let's say whatever it is, I don't even care. Whatever the number is, whatever that first year is, I think it may make sense for you to look at that brokerage account and pay for the first year out of that brokerage account. Because, in a weird way, the 529 asset is more valuable the longer you wait. So you might as well let that balloon up. I would pay for the first year out of that brokerage account and not look back. Who cares? I mean, you've got index funds. You've probably owned them for a while. You probably have a pretty darn good gain in those. Maybe not so much, with craziness in the markets and all that. But I think I would want year 1 to be paid for out of that. Then you get to kind of see what happens when the kid's out of the house and how the cash flow goes. I just think that the next 4 years are going to be kind of interesting. And, what you can know is that you've got the last 2 years dealt with. Let's deal with year 1 out of the brokerage account. Then let's see kind of what happens. Listen, maybe you'll do both years. Maybe you'll do years 1 and 2 out of the brokerage. 529 is year 3 and 4. Whatever. Okay. Just be happy with that. That's fine. Okay. We'll get back to Dave's question in just a second. Hey, during the break, while you're on the Jill on Money website, just sign up for the free weekly newsletter. It's free every single week. Mark does a great job of curating content from across the web. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. Is there something going on in your financial life that just doesn't feel quite right? Are you about to make a big decision? Are you weighing a couple of different job offers? Maybe you're trying to figure out how to compare apples to apples. We can help you with that. And not every single decision that impacts your financial life is purely financial. Maybe there's something really great about the flexibility that your current job allows. Maybe you're able to look at a pension that will pay off many dollars in the future that you're not accounting for today. Whatever is on your mind, we'd love to hear from you. Just go to jillonmoney.com. That's the website. And while you're there, you can just click on the Contact Us button. Right now, we are getting back to Dave, who's on the line from New Jersey. We're talking about his potential retirement at age 60. And you have an emergency reserve fund, right? You have like a little cash on hand somewhere?
We have a little bit, probably not as much as you'd normally have. I have 30,000 set aside, but to be honest, in 2 public sector jobs,
you're not
a little more security than other people.
Yep, I agree. I understand that. Okay, so now we get done with college and now we're coming into retirement years, right? Are you saying the age 60 because like, oh, I'm fried, I got to get out of here? Or 60 is like, maybe, but I could do 62. Like, what do you think the likelihood is here?
So there's an interesting thing there. I have a couple of options. One is I could just go at 60. There's no pressure either way. One of the things I'm thinking about doing when I retire is I can do, when you fill in for someone who's not working, like if they have a gap, they need a principal for 6 months. You can do this work, like kind of like gig work for 6 months here or there.
Nice.
There's a lot of administrative jobs I can do.
That's kind of cool.
I can do that and draw a pension. The other thing to consider, and I don't think I can get my wife to work a day more than what she's already scheduled for.
Listen, leave her alone. She's worked hard. She's done her thing.
Here's the interesting thing about this pension is that every year we worked together, if we both worked, every year past age 59 and 60, the pension goes up $500 a month. So it's like if you get into a jam financially, it's like, oh, okay, just work another year too. And Yeah,
that's pretty good.
Good like fallback plan, I feel like.
Okay, that is good. And you know what? You'll know more once we get through the college years. That's what I think. Then what we need is retirement until Social Security. That's really what the next game plan is. From that period, what's going to be interesting is whenever you retire, you're going to have income. So it's not like you're going to go into a 0% tax bracket, right? You're not going to be one of these people who's like, yeah, my tax bracket went way down. You'll pay lower taxes, no doubt. You'll probably move from a top bracket of, say, 24%. You might squeeze into 22%, because you'll be making good money. Maybe what I would do is from the day you retire until you start getting Social Security, I might start pulling some money out of your traditional retirement account. I know that people are like, oh, but it's growing tax deferred. Yeah, but you know what the tax liability is going to be. And once you start getting Social Security, your tax bracket's going to be high. And I don't know where tax rates are going. So I would think what you would do is from retirement until claiming Social Security, whether it's 67 or 70, because that's going to kind of depend on whether you work an extra couple of years or not. Then I would start using my traditional IRA and 403B, which will probably get combined after you leave, and use that to fund your cash flow needs. And again, as you said, it may not be a lot. It might be a couple $1,000s a month for 7 years or 5 years or however long that is. Use that account. Pay the tax that's due. Don't go crazy. Don't take it all out, but just use that. Then whenever you claim Social Security, you guys are in phenomenal shape because your pension and Social Security will cover your needs. That's going to happen just automatically. And if you really want to use that 12,000 as the bogey, if you say we really do want to spend 150 grand a year because we're really happy and we want to spend, then work an extra couple of years. You have the ability to do that. So if you want to spend more, you work an extra year or two. Or as you said, you can always do a little extra work on the side. Although, that contract work sometimes can drag you right back down into the rabbit hole. But for me, and this may be different for you, it might be more fun for you to like get a new school and have some fun. For me, I'd be like, oh, I know where the warts are in this job. I've got this mastered. It's a pain in the ass, but I know who the pains in the asses are, and I can navigate that. You go to a new place, you got to figure out who's who and what's what all over. I don't know. I don't love that learning curve when I'm 62. That's just my 2 cents. Mark, have I missed anything?
No, I think he's good. I would definitely keep making those retirement contributions because if you keep contributing what you're contributing for the next 7 years, by the time you're 60, that's going to be around $1 million. And I know he asked, should he make his contributions from here on out Roth? I probably would because you don't have any Roth. You're going to have a lot of income.
Yeah, I think that Roth is good. Oh, Mark, keep yourself on for this. I forgot we were doing Jill on money and not I on money. So Mark's voice again, ladies and gentlemen, you've heard it. I think that sounds good. And do you guys have all of your estate documents done?
So we don't. Here's what we do have. I bought the software to do a will this week, knowing that I was coming on the show.
Oh, it's so good. It's like knowing it's like the hammer's going to drop.
Yeah.
So, yeah.
And then we don't have any life insurance. I think I need to pick up a little bit more. We do have with our pension.
Wait. Hold on a second. Yep. Why do you need life insurance?
Just because I'm thinking we have big college bills coming, and if one of us drops, we lose that pension.
Yeah, but it's going to be expensive. Can you buy something through the school system that's cheaper or through your union?
I can look. I mean, here's what we have. We have 3.5 times our salary each. That's just part of the deal of being in public education and the pension system. So for me, that's 500. For my wife, it's, I don't know, a little less.
Well, then that's not so bad. But
yeah, so there's that. That's like a good buffer against like college bills and, things like that.
I don't know. I think it's going to be expensive for you to get like a 10-year term policy. I think it's going to be expensive. But check it out. Maybe you can get something cheap through, like I said, through an association, perhaps. And if you can bang it up if you can increase it to, instead of 3 times, go to 6 times or something, and then, peel it back as you start accumulating more money. Do a little investigation on the life insurance. Get the will done. Do you have a retirement question? Do you have a last-minute tax planning question? Do you have an education question? Because education decisions are coming up pretty quickly. Whatever it is that is remotely financial, we'd love to hear from you. Just go to jillonmoney.com. That's the website. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money, and we are here taking the mystery out of your financial life. Next up, we've got Jessica from South Carolina. Hi, Jessica. What can we do for you today?
I wanted to do a health check, see how I'm doing and what changes I should make in the future. I'm 47 and I'm hoping to retire at 55.
What? Wait a minute. Wait a minute. Why 55? Do you do something very hard? Are you law enforcement or are you a firefighter? Like, what are you doing that you're so burnt out at age 47 that you could only see doing it till you're 55?
I'm a programmer, or I was. I just recently changed to a different position, which has eased my stress considerably. But
really?
The being on call and the stress really got to me.
I'm sorry, but it's better now.
It's better now. Yes.
Okay, so maybe
now. So maybe 55 won't happen.
Exactly. Maybe I can get you. Maybe we've just extended your life work to age 60, but maybe you can do 55. Let's see. Tell us, first of all, how much do you earn?
I earn about $130.
Okay. And do you use a retirement plan at work?
Yes. I have 401k with 3% match. They have both Roth and regular 401k, which is one of my questions about how I should leverage that.
I'll just do it before we get going. Like, use the Roth. Definitely use the Roth, because at $130,000, your top bracket is 24%. We probably could figure out how to get it down a little bit. But Mark, I know is going to say Roth. So I'm going to answer that question up front with, you should use a Roth for sure. Now, my next question to you, how much money is in the plan right now?
I have 315 in the traditional 401k and then 33 in the Roth 401k, because the Roth 401k was a recent addition. So
Got it. And you're maxing out your contribution? You're putting in 20,000? Yeah, good. And are you doing any other saving outside of your employer-based plans?
Yes. I have 90,000 in a traditional IRA, 200 in a Roth IRA, and I'm still contributing to the Roth IRA, though I can't do the full amount because of my income level.
Right. You get phased out.
Right.
Okay.
And then I'm also just putting in a plain brokerage.
You're a saveaholic, lady. How much is in the brokerage account?
230.
Whoa. You're killing it. What about a home? Do you own a home?
Yes, I own a house worth about $295,000 free and clear.
Free and clear? Do you have no life? Like, what's going on? You spend no money. Let's help Jessica spend some of her money. Were you trying to kill it on all of your saving or not?
Yes and no. I mean, I'm very family oriented. I just don't tend to have a lot I want to spend money on.
So what else should we know about you and your killing it on your savings in life in general? Is there anything else that we should know?
The only thing is, one of the things I'm considering if I do retire at 55 is maybe do some kind of second career at a much lower income level, but I haven't really fleshed that out in my mind yet.
You know why? Because you've been on call and on edge for however many years, and now you can relax a little bit, do your job, and contemplate that. I think that's great.
I'm sorry, I forgot to mention my pension.
A pension too? When does it kick in?
I can do it really at any time. I mean, the amount's going to differ when I take it. But
okay, let's do your 55.
I don't have that number. I have how much it would be if I retired at 55 and took it at 65.
That's fine. Let's do that.
And that would be, if I did a lump sum, it'd be about $500,000. If I did a monthly, it would be $33,000 a year.
Whoa. What do you spend on a monthly basis?
Maybe $5,000. Probably a little more than that.
Let's say 6,000 because we want you to spend a little more. Let's say it's 6,000. Okay. So here's my back of the envelope calculation for you. Pension plus your Social Security at whatever your full retirement age is, probably 67-ish, right? My guess is that most of your retirement needs will be met between your annual pension and your annual Social Security retirement benefit, that most of your needs will be met. Not 100%, because I'm doing like a back of the envelope calculation, and that, you know, there's obviously going to be inflation, but you have all this other money that you've saved. You know, this $900,000 that's already saved, you know, you can just use whatever you want out of that to fund what your pension and Social Security does not cover. Now, the only thing is, let's say you stop working in 8 years. Okay, so you will have saved more money. So that's good. But then we have this, you know, this 10-year time horizon that's going to be important for you. So there's two ways to think about the 10 years. One is you could say, all right, you know what? I'll do something and I'll get some job. I may not make $130,000. I'm going to make it up. Let's say it's $50,000. Okay. You'll get some job that pays you in today's dollars, $50,000 a year. You'll get health insurance and you'll cover maybe 2/3 of what you think you really need to live on. Not the whole thing. And then you would have to spend some of the money that's in your brokerage account to cover the difference. We'll get back to Jessica in just a second. Remember, our website, JillOnMoney.com, holds all the answers to your questions. Check out all the content that is refreshed all the time. Okay, we'll be right back. You're back. It's Jill on Money. Let's get back to Jessica from South Carolina. If anything, you know, I would be interested in beefing up the brokerage account. How much do you put away in that brokerage account on a either monthly or annual basis?
I think it's about 300.
$300? Okay. I wouldn't even put any more money into the Roth account in your Roth IRA, that part that's being phased out. I would just put it all in the brokerage account. I'd love to build up your brokerage account. Here's why. Because you have this 10-year period where you're going to need to access funds. And I think it is far better for you to access money from that brokerage account than build up more retirement reserves. Your retirement is in very good shape. So I think if you could actually save a little bit more money outside of retirement, that might give you the ability to pull the trigger at 55 and really say, okay, I'm going to do something different, or I'm going to not work and whatever you end up doing. But I think that those 10 years are kind of critical for you, right? Because you'll need health. You don't have any health insurance accessible at 55, do you?
Not that I'm aware of.
Okay. So then I think that we have to build up the brokerage account. Do you have an emergency reserve fund?
Yes.
How much is in there?
About 32,000.
Okay. I guess I'm also presuming, maybe erroneously, but I'm presuming you're staying in your house at age 55. Nothing's going to happen there, right? You're not moving at age 55, right?
Probably not. I will downsize at some point, but it'd probably be later than that.
I mean, I don't think there's anything you really need to do in terms of focusing on something so different than what you're doing. I just want the way that you're saving. I just want to carve it up slightly differently. So I think that using the Roth 401k makes sense. Pulling back on the amount of money you put into the Roth IRA and redirecting that into the brokerage account, that makes sense. But other than that, I don't see any big move on the horizon for you. And frankly, if you're single and no one's relying on you, right? You don't have a dependent or anything. You don't have a sister or a parent who's relying on you.
Not at this time.
Given that, and it's just you, I think you can do whatever you want. Okay, stay tuned. We have a great guest joining us. His name is James McIntosh from the Wall Street Journal. It's Jill on Money, and we will be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's hour number 2 of Jill on Money, and I am delighted to introduce a guest. His name is James McIntosh. He's a writer at the Wall Street Journal, and he caught my eye because he wrote a series of articles about sustainable investing. And it really is a craze. And the funds that are guided by the principles known as environmental, social governance, it's ESG, these funds have gained tremendous popularity. So Mark and I thought it would be a great idea to bring James McIntosh on to discuss with us what's going on in the ESG world and what we need to really think about as consumers of these funds who are trying to invest perhaps in a way that aligns more with our values. Here's the first part of our interview with James McIntosh. Why did you want to write this series?
This is the big fashion in markets. One of the big fashions in markets: environmental, social, and governance. The ES and the G. It's dominant now in Europe. You aren't going to get, if you try and raise money from a big pension fund, one of their questions that you absolutely have to say yes to before you'll get any money as a fund manager is that you have an ESG policy. It's coming in, it's being written into law in Europe, and it's coming in the US in quite a big way. Lots of money going into ESG funds. So purely in my role as a columnist, this is an important thing to stay up on. But the particular reason for doing this is that I really don't like it when people try and market something as something else. I think it's misleading. I mean, one of our jobs as journalists is to show these things up, and I just think there's a sort of deep flaw at the very heart of how ESG is sold to people. It's got these two aspects. One is they claim, hey, this is going to outperform. It's going to make you money. You want to be in this. Standard appeal to your greed. On the other hand, they also tell you, oh, by doing this, you can help to improve the world and make everything better, which is an appeal to your conscience. And I think you can have one or you can have the other. And I think it's very rare that you'll get both in one place.
I remember when I was first starting to research this because I got one of those report on U.S. sustainable and impact investing trends. And the first thing they said that was interesting, this is back in 2020, so I'm sure the numbers have changed now, but that report said that sustainable investing assets account for $17 trillion or $1 in $3 of the total U.S. assets under professional management. Is that number real?
No.
Because I was like, that seemed like a lot. So how do we know it's not real?
Well, the United Nations, for example, supports this outfit called the Principles for Responsible Investment, for which people sign up to say that they're responsible investors. Another way of saying ESG. There's lots of language around this. They say they've got $121 trillion of assets under management. Now, that's worldwide, but the US is well over half of the world market. So highly unlikely that both of those numbers are right. Morningstar has yet another set of numbers. Everyone has a set of numbers. You can talk to any of the big investment banks. They all have numbers. None of them match. Everyone has different numbers. That's why I'm confident in saying it's wrong. I'm not saying I know what the answer is, but it's not that.
Okay. I want to do a little more fact checking with you because before we get into this, we want to make sure we're sort of understand that is not everything. I have a report from McKinsey, and here's the quote. You ready? A strong ESG proposition correlates with higher equity returns, and it, quote, also corresponds with a reduction in downside risk. Oh, so all I have to do is invest in an ESG fund and I have lower risk and higher returns? That sounds awesome.
Yeah. Pick your period and pick your ESG score and you can do it. It will also show you plenty of exactly the opposite. You can prove anything with statistics, as they say. One very basic thing, I was running some numbers earlier. If you invested in world coal stocks, which are perhaps the absolute inverse of at least the E bit of ESG, you would have outperformed world stocks over 1 year, 2 years, 3 years, 5 years, or 20 years. On the other hand, if you wanted to prove the opposite, over 10 years, you would have done way better if you'd avoided coal stocks. Which is true? Well, they're kind of both true and neither are true. Coal isn't necessarily a good investment. It's not necessarily a bad investment. If you buy it when it's cheap, you might outperform. If you buy it when it's expensive, you might underperform. Same goes for ESG.
I also want to kind of back up a little bit as we talk about ESG. Explain to me how this is measured, because it feels like, I don't know, first of all, how are we evaluating a company to determine whether it's environmentally friendly? Okay, maybe Royal Dutch Shell is doing good things, but it's still a massive oil driller. So what is it that is the metric on which we are basing the ESG ratings?
This actually is the second reason. Go back to my coal analogy. If I say coal stocks have outperformed, one pushback to that is, well, what counts as a coal stock? Some companies are indubitably coal stocks, and some companies you might say are indubitably at least environmental stocks or socially doing the right thing or have very good governance. And there are companies you can point at where you definitely have at least one of the three. But what about a company that generates 25% of its money from coal mining? Is that a coal stock? Well, it depends on your definition, right? Exactly the same with ESG. What counts as an ESG stock? Well, it's subjective. There is no absolute here. And there are dozens, probably more than 50, maybe more than 100. I can't keep count, and no one really keeps count, of different groups rating, selling ESG ratings. And they all do it differently. There's no agreement on how to do it. It's sort of right that there's no agreement on how to do it because it's subjective, right? So Exxon, for example, is generally rated as being pretty good on a sort of social basis. It tends to have lots of local philanthropy, and it supports its workforce well, and it treats people well, whatever their sexual orientation and so forth. So it scores quite well on social aspects with lots of places. It obviously is a very major oil driller. It also does well on G. It's got pretty reasonable corporate governance. But it's a big oil driller. How do you balance those things? Well, it's a purely subjective question, right? Which do you put the weight on? There is no absolute answer. One result of that is that you can almost always find what you want. So I looked at this a couple of years ago and got some academics to run across a whole bunch of different scoring systems for me. And it turns out that there's a tiny handful of companies that don't count as in the top 25% on at least one of ESG. So when you see the chairman in the annual report going on about how great they are on their environmental issues or how great they are on their social issues, take a look at the other two, because they probably picked that one because they don't do very well on the others.
We'll get back to our interview with James McIntosh in just a second. During the break, hop on to JillOnMoney.com. While you're on the website, why don't you sign up for our free weekly newsletter? And of course, if the newsletter spurs a question, feel free to ask it. You can just hit the Contact Us button and we'll get your note. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are going to return to our interview with James McIntosh from the Wall Street Journal in just a moment. We're talking about the ESG craze, and I mean it is a craze. This is something you've probably heard a lot about. ESG stands for Environmental, Social, and Governance, and this has become just a massive subcomponent of the Wall Street money machine, a way to gather assets. And I think that it is important to note that while you may hope to do really good by investing well, or well and good, I don't know which way that should be, McIntosh warns that this could be as much of a marketing ploy as anything else. So it's just something to keep in mind before you start plowing money into these funds. Let's get back to our interview with James McIntosh. Let's just talk about some of the investment banks, right? They all have these huge arms that are like promoting, we've got ESG funds and we've got the best investment funds and blah, 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 right? And at the same time, they're so full of crap because they're financing oil companies, energy companies. They're financing ventures that do some really shady crap. And by the way, they're financing a bunch of companies in China, which has, I think, some problems on the ESG front. So how do they square that?
They tend not to. But the same goes for everything. So if you look at European companies, for example, well, in fact, it's in many cases illegal for a fund to invest in a company that makes landmines because Europe has signed all the international treaties against landmines. And that's written into every single ESG contract would say you can't, if you're an ESG fund, you absolutely will avoid landmines and probably what's known as controversial weapons. Of course, one of the biggest buyers of controversial weapons is the US government, but that doesn't stop them lending money to the US government, holding dollars, operating in dollars. None of that is ever excluded. So these companies might refuse to invest in a maker of nuclear weapons, for example, but the actual buyer of nuclear weapons, that's fine. You can invest in them. So there's all sorts of problems with how all these things are scored. I mean, my broad view, my aim when I approached this series, as I said, was to deal with this question of both the idea that you can outperform and that you're going to do good. But even on the question of, are you doing any good? It's got to be questionable because you might feel better about what you're doing, all the fund managers selling you these products will go out of their way to tell you that you should feel better about it, plastered with nice pictures of children running through fields and the like, right? Every ESG fund has that. That doesn't mean you've actually made any difference to the world. And it certainly doesn't mean you've actually made any difference to the bits of the world that you really care about.
And what's interesting, I mean, just going one level down deeper before we get into some of the solutions, if you really do want to make some changes, I have this article which was forwarded to me. So I did not go deep into this. So I just want to be honest with everyone. The European Securities and Markets Authority last week reported wide disparities in how credit rating agencies incorporate ESG factors. And this follows a report from the U.S. SEC earlier this month, which warned that rating agencies face new potential risks, such as failing to follow ratings methodologies and failure to manage conflicts of interest. Boy, does that sound familiar. So this is about ESG products, and especially with regards to something called green bonds. You wrote one of your articles, talked quite a bit about green bonds. So can you talk about green bonds and why those in particular seem to be coming under some regulatory scrutiny when it comes to ratings?
Well, green bonds have had some very high-profile disasters where sort of pure greenwashing, a green bond to build an airport, for example. These sorts of things have been sold. They're less outrageous now, I would say. There are still some things that slip through that you would say, well, that's how can that count as green? But nonetheless, they face pretty much the same problems as the broader ESG area, which is that it's very hard to see that they're making any difference to the world. And then secondly, it's hard to see how they can outperform. On the making difference to the world bit, which is probably the first thing people think about when they're thinking about should they do ESG, coming back to the small children running through fields in the sun. A lot of green bonds, in fact, the biggest amount of green bond issuance comes from governments and multilateral institutions. They would issue these bonds anyway. They don't have any problem issuing bonds. And more than that, they would have spent the money anyway. So the fact that they have relabeled some of their fundraising, some of their bond issuance as green, doesn't make any difference to how they spend their money. If the French government, for example, was going to spend a certain amount of money next year on electric vehicle charging points, that isn't relevant to the fact that it's also issuing a green bond, which says in its prospectus we will spend some of this money on electric vehicle charging points. They're going to spend that money anyway. Even if the bond crashed and burned and nobody wanted to buy it, they'd still spend that money because the French government doesn't have any problem raising money. It's not a big deal and it's not going to affect it. And the same goes for all the government green bonds. And the same goes for almost all of the corporate green bonds too. They plan to spend this money. What's happening is they're creating a new silo because people want it. So what used to be sold as one lot of, let's call it grey bonds, they were all the same and you gave them the money and they spent it. Now they split it into two and you have kind of grey brown bonds that don't really say what they're going to spend the money on and green bonds that do say what they're going to spend the money on. But ultimately the money all still goes into the same big pot. Your default risk is exactly the same for both of them. They can't default on, or they're not going to default on just one of these bonds. If they default on everything because they got the same guarantee from the company. It's not project finance. It's not that you give them this money and say, yeah, I'll give you the money purely to spend on this and I'll take the risk that this new thing, these electric vehicle chargers, will make enough money to pay back the bond. That would be a sensible way of doing it, but it's too risky for investors. They don't want to do that. So you end up instead with this sort of botched thing that doesn't make any difference to the world.
We'll get back to our interview with Wall Street Journal writer James McIntosh in just a moment. Now, if you have a couple of moments in this break, here are some ideas for you. Number one, go to jillonmoney.com. And if you've got a financial question, just click the Contact Us button. So easy. It's right there. And once you complete that, at the very end of the form, it says, would you be willing to come on the air with us? And if you click yes, Mark will do everything else. While you're on the site, check out our 2 podcasts, not one, but two. There's the Jill on Money podcast. There's the Eye on Money podcast. And we've got links to help you subscribe to that. You know, if you already do podcasting, you know how to do that. So Jill on Money and Eye on Money, those are our podcasts. Also, what else is on the website? Well, I write a column for Tribune, and sometimes I just write musings in general. So check out the blog where some of the things that we touch on here, we get into a little bit more depth when I'm writing about it. And you'll think, oh, she doesn't actually write like she sounds. I know. It's always a little bit different. Also on the website, check out the TV stuff that I do and the resources section, which I think is so valuable. So if you have a moment, you might want to check out those resources. And if you have a suggestion for a resource, well, then I suggest that you let us know because we want to share it with our whole community. That's the beauty of the Jill on Money community. We share stuff with each other. So check it out. Everything is there. JillOnMoney.com. That is the website of choice, at least for this show. Okay, so when we return, we will continue our conversation with James McIntosh from the Wall Street Journal about ESG investing. So many of you ask about it, so that's why we have him on. Okay, we will be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. Here is the conclusion of our interview with James McIntosh about ESG investing.
Let's define a few different groups. So the first lot, there's a group of people who don't want to invest in something because they regard it as bad, morally wrong. They don't want to be associated with it. You know, there are funds that will invest in line with various religious groups. So they might say, well, we won't invest in manufacturers of condoms if they're Catholic. They might say we won't invest in companies that charge interest if they're Islamic funds, and so forth. So there are things like that. There's a vegan ETF, right? If you're vegan, you might say, well, I'm going to invest in that because I care for moral reasons. Perfectly reasonable. I think you should expect over the long run, not necessarily over any specific period, but over the long run, you should probably expect that you'll underperform simply because you've excluded a bunch of stocks. You're less diversified. On average, over a long period of time, that should lead to underperformance. You can't sort of adjust for that. That's just what people believe. Fair enough, right? I don't have any criticism of that if people want to do that. Perfectly reasonable. There's lots of funds out there that cater to that. To some extent, you might say the same with environmental. You might say, well, look, I don't think anyone should be mining coal, so I'm not going to invest in it. It's fair enough. You can buy an index tracker that is the index minus coal stocks, for example. And again, perfectly reasonable. You should probably expect over the long run that would very slightly underperform the market because you're less diversified. The second thing is you might say, well, look, politically, I strongly believe that something is going to happen. And that's where a lot of particularly the E aspect of ESG people say something, right? So I strongly believe that the world, having signed up to the Paris Accord and having made all these promises about carbon emissions, are going to follow through. And that means that there's going to be some clampdowns on the use of fossil fuels in order to meet those promises. Now, if you believe those things are happening, you probably think that fossil fuels will be less appealing on that basis, right? Fossil stocks are going to be less profitable. And that's perfectly reasonable, right? You might do that, whatever your belief about actual climate change. I mean, in principle, you could deny that climate change is happening, but still think that governments are going to act on it. If you believe governments are going to act on this, then you probably ought to feed that into your investment decisions. Now, I don't think that means you should buy an ESG fund, but it means you should, at some level, invest according to how you think that's going to that's going to affect the prices of those assets because it'll be quite significant, right? So probably I would say most people will get it wrong. I'm probably with you on this. Buy an index tracker, right? If you don't really know how to do that. But certainly, if you're a fund manager and you think that, you probably ought to be factoring that into your decisions. And if you're a big pension fund as well. The first one is pure morals. You accept that there's a trade-off with investment. And the second one is pure investment, ignoring morals. You don't need any moral view, right? To say, well, this is the way the world's going. I want to invest according to how I think the world's going. But you've got to accept you might be wrong.
You already wrote it cynically, so you now have to do the optimistic side.
Well, look, there are ways you can make a difference. Clearly, you can make a difference with your money, right? If you go out and you say, I found this guy who's got a brilliant idea to make a new power source, replacing major battery backups using cranes or old mines, creating hydrogen using microbes, right? These sorts of stuff, which is cutting edge to the extent where none of it so far really works. If you think that maybe it can be made to work, right, you can step in where no one else is willing to step in and finance it. And if you do that, if it works, right, hey, you had absolutely brilliant venture capital investment. You were the first guy who solved one of the major problems of the world, and you'll make a ton of money. And probably the reason other people won't finance it is this is wildly speculative stuff. Much of it won't work. But if it doesn't get financed, it's definitely not going to solve the problem. So if you've got a lot of money out there, you can step in and do these things. And there are some people who are doing that, who are explicitly saying, well, I'll finance these startups. And there are some venture capital funds that aim to do this. You can say, I'll finance these startups because I want to help the world, and I'll keep my fingers crossed that it'll bring with it a fat return because some of these projects will work out and microbes will eat waste and produce energy, and it'll, all the planes will be flying around on my magic fuel that I created using this. And other companies will crash and burn because it'll be a disaster. And you've just got to accept that that's how venture capital investing works. If you're lucky, on average, you'll make money. If you're unlucky, none of the projects will work out and you'll lose everything. But you can at least feel that you're really making a difference to the world because you're financing something no one else would finance. So that project would not have happened without your money. And that's a definite, that's one way you can say, absolutely, that made a difference. You can, of course, change your behavior.
I like that one. It's the one that feels like most applicable to the VAT. I mean, I don't have millions of dollars or billions of dollars to fund a venture, but I can control what I do in the universe.
Yeah, you can do that, and you can try and persuade your friends to drive less and to cycle more and to eat better and to treat other people more nicely and all of the other things you want to do to change, to improve the world, right? Yeah, frankly, if you're an ESG investor and you're not doing those things, I think you're probably making a mistake. But you should also accept that you're not going to make very much difference to the world by doing that, right? Your personal behavior as one of billions of people in the world isn't going to be enough to make the difference. It's a good thing to do, but it just on its own doesn't do it. A second thing you could do, you can make sure you vote. One thing that particularly is happening now is lots of proxy votes are happening to force some of the big companies to, at the very least, disclose stuff, to say how much lobbying they do of governments. For example, if the government isn't, clearly one of the most effective things that can be done on many aspects of ESG is that the government can step in and make it law. And if that happens, then that thing is going to be much more widely followed on whatever issue it is that you think should be done. You can make the company at least stop lobbying against that issue, if that's something you want. That's been done at quite a lot of oil companies that have now pulled their funding for lobby groups that were trying to convince politicians that global warming wasn't real, for example. So you can stop companies from financing those groups via proxy votes. If that's something that you feel strongly about, that's a thing you probably should do, right? However you're invested.
Okay, if you've got a question about ESG or anything else financial, just go to jillonmoney.com, click Contact Us. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. Time for some of your questions. Let's talk to Ben from Minnesota. Hello, Ben. How are you?
Hello, Jill. I'm well. Thank you.
Great. What's on your mind? What can we do for you?
Over the past year, with the market going up and down, and I've become kind of less tolerant of fluctuations, and I am headed toward my 75th birthday. And I think I need to revamp or try to get a better handle on controlling the vulnerability of my current investments.
Okay. So how are you surviving right now in terms of income? Where do you receive income? You have Social Security?
I have Social Security about $1,500 a month after Medicare premium is taken out. I have a part-time job. It brings in $60,000 a year.
Wow. That's awesome. Any other income? Pension?
No.
Okay. Are you married or are you living all by your lonesome self?
I'm living all by my lonesome self.
Oh, well, maybe not by the end of this call. Maybe we'll find you a suitable mate. You never know. Tell us about the investments that you have. Is this primarily in retirement accounts or non-retirement accounts?
I have a one set of investments, about 100, as of today anyway, about 180, well, it's 178,000 in a traditional IRA.
Okay.
And then I have a non-qualified account, 483,000 today. And then at my job, Roth IRA, but I have learned that a Roth IRA within a retirement plan behaves just a little bit differently than a
Okay, like a Roth 401k. Where do you work? At a for-profit or non-for-profit?
Nonprofit.
It's probably a Roth 403b or 457, but okay, not a worry. So What about just plain old cash on hand?
You know, it's one thing that I haven't done a good job of. In my checking account, I only have about $4,000 currently.
I skipped over. I'm sorry. How much is in that Roth retirement account through work? How much is in there now?
132,000.
Oh, that's great. And what about the house? Paid for?
I have a tiny mortgage. In fact, the interest is so low, I've just been thinking about paying it off and getting it.
What's the house worth?
Probably $240,000. It's a tiny little house.
And the outstanding mortgage amount?
$27,000.
Okay. So you're at the end of this. You got any kids? Grown kids?
I have two children.
How old are they? They're okay?
39 and 42.
They're doing okay? You don't have to help them out?
I have helped my younger daughter. I have helped with the purchase of a home that she's currently living in.
But she's all right. Like you helped her with that, but you don't need to give her money every month, for example.
No, I'm not. Okay. No, she's paying her own way, struggling at times, but getting along.
And what about the 42-year-old?
She's married and both have good paying jobs.
Anyone else you have to take care of, siblings or anything like that?
No.
You got your wills done and power of attorney and healthcare proxy, that stuff done?
I do.
Good. All right. Are you you've got to take your required distributions from your traditional IRA. How much are those RMDs right now?
It's about $5,000. And I don't have to pull the RMDs from the retirement.
Of course. Yeah. Yep. So what do you figure you need to live on?
I think I could live on $3,500 a month.
Okay. And how much longer do you think you're going to work?
You know, I love my job and it's convenient and they're very flexible with me. So I don't know, you get pressure. Everyone asks me, well, why don't you quit working? And I said, well, there aren't too many part-time jobs that pay like this one.
Yeah, I'll say. Keep doing it as long as they'll keep paying you, as far as I'm concerned. You're in great shape, okay? You are going to keep taking the required minimum distribution as they make you. You're not dipping into this money. This story you've laid out argues for a balanced approach to investing, because at some point you are going to want to start pulling money out of these accounts, right? To replace the $60,000 a year. Right. Not the whole 60, right? But, when you think about it, you need essentially $2,000 a month. you have 800 grand right now. So you're in very good shape. That means that you're going to be able to take the money out. Honestly, you'll be able to do it quite easily. I wouldn't really start to make myself crazy, but I am interested in what do you think the breakdown is of your allocation in terms of stocks versus bonds versus cash right now? Like, are you like a 70-30 kind of person, 60-40, 50-50? What do you think you are?
I think everything is in mutual funds.
Yeah, but how much is in stocks versus bonds versus cash?
I don't think there's anything in bonds.
Well, now I know why you're on that wild ride, man. So you're basically 100% in stocks, essentially.
Yes. In the retirement side, that's not the case. In my retirement breakdown, it's 25% in bonds and the rest in stocks.
That's nuts, dude. I mean, it served you well, but that's why you're like on a serious ride. Look, you don't need this money. And even if the stock market falls dramatically from this place, I don't think it's going to be so awful for you. But why be on the ride? You already did the hard work. You got your 800 grand. You've done an amazing job. So I would definitely shift some of the money into bonds, especially the money that's in the traditional IRA and the Roth. We'll get back to Ben in just a second. If you've got a financial question, JillOnMoney.com is the place for you. We'll be right back. You're back. It's Jill on Money. Let's conclude with Ben from Minnesota. I'd like you in your traditional IRA, where there's no tax issue, that you would start to get closer to, say, 50-50. 50 stocks, 50 bonds. And you can do it every month. You can make a little change. No deal. There's not going to be a big problem with that. In your non-qualified, your non-retirement account, I would like you to start to make some sort of plan that at least this year that you start shifting some of that money over into cash and short or intermediate term bonds. I'm thinking that 50 grand a year, Mark and I think, will get you more to 50-50 in the non-retirement account. And you're going to pay some taxes. So what? Pay the taxes. That's what I say. Who cares? Pay the taxes. If you want to reduce the risk, you're going to have to pay the tax that's due. And it's not such a bad thing. I mean, when you stop working, you're going to have more reliable account balances and more reliable income so that you're not forced to sell when there is a market event. So what you want to be thinking about is you're going to need this extra $2,000 a month or 25 grand a year. When you stop working, you're going to want to have 25 grand in cash, in your non-retirement account, so that you can basically say, okay, I've got my 25 grand. I know I've got that set. Not a problem. You can throw it into your bank account. That's fine. And I might even have a little bit more. I think I'd probably want somewhere like 1 to 1.5 years in cash of your needs. So that means that you're going to need $25,000, $35,000, and you're going to have to sell some stuff, pay the tax that's due on it in order to make this happen. And I'll tell you what, you're putting money into this Roth right now. I wouldn't mind if you stopped doing the Roth contributions and just put the money in cash and just like have that money available as cash on hand. You should have more cash on hand for yourself.
I mean, I can do that right now. I'm putting $350 a week into that Roth.
I don't think you need to do that anymore. And you got plenty of money in retirement. You got plenty. You did a great job. Well, that's it. That's the show. Thank you so much. Our music is composed by Joel Goodman. Mark Talercio is our executive producer. Everything we do here can be found at JillOnMoney.com. And please, please try to do something nice for someone else today. Thank you for listening, and we'll talk to you next week.